they still get a Social Security benefit that's half of what your benefit was, even if they didn't work one day.
And even if you get divorced, they're still going to get that.
Yeah.
Even if you die, they're still going to get that.
Now, here's another thing you can still do with your spouse without having them on payroll.
They still feel compensated, but you didn't put it on a W-2. They're on the board. You're covering all these other expenses. It's a win-win-win. What do you feel is your best, most safe investment?
Welcome, everyone, to the Main Street Business Podcast. This is Matt Sorensen, joined by the insatiable Mark J. Kohler.
Insatiable. I love these new adjectives.
Yeah,
You've been playing around with the source a little?
Insatiable, yeah, it's a great one.
Okay, I'll use that.
Look it up, folks. Look it up, folks.
Look it up.
You just can't get enough of him. That's what it is. Mark J. Kohler. It's insatiable. You just can't get enough of him.
Well, thank you so much. Well, thanks, everybody, for being here. This is going to be a great show today. We're really excited about this. For those of you out there that are married, sorry. You saw in the title, should I pay my spouse or not? Well, some of you are like, of course not. And others are like, I sure should. Yeah, damn straight. And then all those single people are like, I don't care. So some of you might be head at a dinner party. If you're not married and want to learn this, there's actually a lot of incredible insights that you have to have on this topic.
Yeah, and one of the most common questions for business owners when they're starting up a new business or as they're growing, their spouse is involved, they're kind of on the sidelines, they're there day to day. There's all these different factors here, but this is a very, very common question and one that has some tax and financial ramifications. So we want to make sure we cover it so you know the scenarios. When should I add them? We want to break down a number of misconceptions too. There's a number of misconceptions about reasons to add them that we want to dispel. And then also we're going to hit the scenarios of like, definitely add them in these scenarios.
Yeah.
This is when you do want to actually add them.
Totally. And I know some of you are shocked. You're like, well, of course you should, because they need Social Security or this or that. So we're going to break down a lot of misconceptions because a lot of people think the answer is non-debatable. And I will point this out for the end of this. There are some ways from a political standpoint when you talk about when you're in a marriage and it's a partnership and there's no way it's not, your spouse is not involved in the business. We're going to talk about board of directors and how you can compensate your spouse so that he or she feels that they're being fairly compensated for the wear and tear on them and the family and you. And so they do need to be compensated, but putting them on payroll is really what we're talking about. We'll give you some ideas on how to do it most effectively.
Yeah.
So.
Well, should we talk about why you may not want to add them? I mean,
Yes,
that's the first thing right out of the gate here, because it's like adding them on payroll means you're also going to be paying in to FICA. So if I'm like, well, I'm going to pay my spouse $50K. Oh, are you? Okay. You know, you're paying into Medicare, Social Security as the employer. Yeah. You know, the business is going to pay that. And, your spouse, by the way, too, is going to get half of that withheld, too, on their paycheck as the employee. Yeah. So that $50K adding them on payroll is going to actually cost you 15% on both sides of it, which is, what is that?
Oh, you're gonna be
that's a lot of money. Yeah, that's $7,500.
And what I wanted to say, I was going to start doing the math. It's more than that. You've got SUTA, state unemployment, FUTA, federal unemployment. You may not even, she or he may not even be exempt from workers' comp. So now you've got all these additional payroll costs that are going to kick in if you add them as a W-2 on your company.
And because let me say this too, because you could otherwise just take that $50K that you would pay your spouse, right, and just take it in the business as profit. I didn't have to pay that. That's into right. Medicare or Social Security or unemployment or add them to workers' comp.
Yeah, I mean, maybe we're assuming, folks, you know this, that if you don't pay your spouse the $50, you're going to take a draw of $50,000 and it's going to go into your joint marital bank account or as marital property, essentially. So whether you take the $50 into your personal account or you pay your spouse the $50, the money's going to end up at the end of the day in the same bank account on the same 1040, which we're going to come to here in a moment. But what you're avoiding are all of those payroll costs of putting them on payroll. Okay, so that's number one why you don't want to do it, is that first. Number two, is there really a write-off? I mean, I get a write-off, I guess.
Yeah, you can write it off. Okay, let's say you paid your spouse that $50K, all right? You paid some taxes on it for the Medicare and Social Security and all the other stuff we just mentioned here. But you're like, yeah, but I got a $50,000 deduction, Matt, because that was wages. Yeah. $50,000 deduction.
Yeah, you don't pay tax on that.
Yeah.
I'm sorry, you're married? Don't you file a joint 1040?
There's a W-2 that's going to pop up. It's going to hit your 1040, and that $50K is coming right back.
Yeah, and you're like, well, we're married filing separate. Okay, by the time you do the math on married filing separate, it's cheaper to do a joint return and you're going to pick up the $50K as well. So you're back to where you started. You just moved $50,000 from the right pocket to the left pocket and it's still in your genes. you still got the money there.
That's how the IRS sees it. Either pocket or taxing it.
Yeah, and if you get divorced, that's how the divorce judge sees it.
It's both pockets, actually.
Yeah. It's all in the genes. Yeah, it's all in the genes. It's not in the banana stand. It's in the genes. It's not the
banana stand.
Yeah, all right.
Arrested Development fans, you know what we're talking about.
Now, here's the big reveal. The big reason why you don't need to do this or want to do it, because you don't want to do it to pay the FICA, but you think you need to because your spouse is going to want Social Security. And I guess that's true. If you don't pay them, they don't get Social Security.
That's myth. Let's bust that right now. Okay, this is also, we're good fans of Mythbusters. What happened to that show, by the way?
Well, I had like 9 seasons. I think they just ran out of myths to bust.
All right, let's bust a myth here. Okay, the nice thing about Social Security is there's something called a spousal benefit. So if you have a spouse who is non-working, or maybe they're a little more part-time, they've been a homemaker, they've raised kids, whatever, it doesn't matter, the scenario here, they can get what's called the spousal benefit of Social Security, which means they get half of the benefit you'd be entitled to. You still get your full Social Security benefit, but they still get a Social Security benefit that's half of what your benefit was. Even if they didn't work one day, okay, they're still going to get that.
And even if you get divorced, they're still going to get that. Yeah. Even if you die, they're still going to get that. When Social Security was established, this is well over 50 years ago or more, they put in this provision to protect the stay-at-home mom back in the day when it was more traditional. But now it's the stay-at-home dad or the stay-at-home mom. Either way, that spouse that's taking care of the household or not working full-time or paying in enough, they may have a part-time job, but they just didn't pay in enough. The government said, whoa, we're going to give you the spousal benefit, whether they die or get divorced or whatever, you're going to be okay. And so it's a protection mechanism, so you don't need to put them on payroll.
Yeah. I have so many clients that are like, well, I just want to give them something so that they get some Social Security. So I want to pay them 30 grand a year, 50K a year. And it's like, okay, and you're taking 100K a year or more. Their spousal benefit is automatically going to be way more than what you're dropping in here to try and add them on payroll. So don't worry, do not do it for Social Security benefits. They're going to get it already. That benefit is almost always going to be more than if you started paying them out of the business. Definitely going to be more once you factor in the Social Security costs, because you do actually pay in to get that non-spousal benefit. Yep. That spousal benefit is almost kind of like this little free ride that they can get, actually.
Now, before we tell you, I think if I can steer this or outline a little bit, I have an idea. Okay. Instead of talking about why you do put them on payroll, let's stay with this for a minute. Why we don't put them on payroll, and what are some of the other ways we can benefit them? What are some ways we can solve this? Yeah. Then we're going to circle back at the end and say, now here's when we put them on payroll. So the one thing that I do think you can do, is that all right?
Yeah.
Okay. I would say,
we had an outline here, and Mark's telling me he's deviating.
I'm deviating. You're deviating.
He's giving me a warning.
I call it pivoting. All right. Okay. I call it improving the show.
It's called audible.
Omaha. Yeah. All right. So if you're not going to put on payroll, what other things can you do? Well, the first one I love is the board of directors. The board of directors or board of advisors option, we've talked about it over and over again on this show, is that every small business should be building a board of advisors, board of directors, and it creates better asset protection, it helps you better manage your business, and it creates write-offs when you travel or dine with your board of directors, and your spouse better be on it. Mm-hmm. It's a great method for travel through the holidays, travel in the summers, and you've said this before, a spouse, they are an advisor. I mean, almost is their most quintessential role.
Yeah, you can't help it. I mean, there's kind of the stresses of business ownership and being an entrepreneur. I mean, who's the most reliable person to talk about that with? Your spouse. You already are doing this. I can't imagine many. I mean, I do that. I know you do. Like we all have this person that's a partner in our life, and your business as a business owner is such a key role in that. They're kind of in this advisory role. Now, there are some spouses that really do work in the business.
We're going to come to when you have to put them on payroll, or we will. We'll come back to that.
We're going to hit that. I know here in a second, but I'm just saying, at a minimum, we know that they're in this advisory role, whether it's a board of directors or board of advisors, where they are formally on like the written business documents. We're expensing some of the stuff that are involved with them as they're participating in the business. We're catching those deductions. Now, here's another thing you can still do with your spouse without having them on payroll. You can actually still make a Roth IRA contribution for your spouse even though they don't have their own earned income. Because that's another thing a lot of clients will say is, well, Matt, they have to have earned income. My spouse has to have a W-2 and have earned income themselves in order to make a Roth IRA contribution for themselves. I want to drop $7K in myself, but I want to do $7K for my spouse as well. So I'm going to give them a W-2 for $7K. No.
Don't have to.
You don't have to, right?
Yeah, another
There's a
myth.
spousal contribution rule that says the non-working spouse can attribute income of the working spouse to make a contribution to their IRA.
Yeah, and this is similar to our conversations that passed on the show about paying kids. See, kids have to have their own earned income, so you have to go through that formal process of paying the kids in order to justify their Roth contribution of $7,000. But with your spouse, not necessary. Again, another benefit of the marriage.
Spousal IRA.
Beautiful, beautiful. But here's the thing. There's ways to compensate your spouse without putting them on payroll. And to close this out before we talk about why you do put them on payroll is, and I alluded to this at the beginning, is you can compensate them through your draw. That if there's a kind of a political thing going on where they feel like, what the hell? I want to get paid. Say, okay, it'll be in your account every month through our draw. It's our draw. It's our marital income. And so if you're going to take a draw of $10,000 a month, just take 5 of it and put it in your spouse's personal account too. It's going to be attributed to you as the draw. And so they still feel compensated, but you didn't put it on a W-2. They're on the board. You're covering all these other expenses. It's a win-win-win. Mm-hmm. But there are those times where the W-2 needs to come out.
Yeah, and we like adding spouses on payroll for a couple of reasons. The number one reason I will do it with my clients is they have a solo 401k or some maybe 401k plan for the business in general.
Yeah, it could be
it could be a group or other. Yeah. They have other employees too. And they want to make a contribution for the spouse. So like, Matt, we already did the $7K to the Roth IRA. We want to drop more in. I want to be able to do the $23,000, the $69,000, and I want to really start socking money away. I've got my own $69K I can do for myself, but you're telling me if I add my spouse onto payroll, I could do another $69,000 in solo 401k contributions for them? Yes, that's possible. Now you need to pay them. We're assuming you're making good money here in the business where you can get maximum retirement account contributions. And this is 401ks. There's no spousal contribution rule like we talked about in IRAs for 401ks. So they will need to get a W-2 to do their own 401k contribution.
Yeah, no, what Matt just said may have flown over your head. That it's super deep. I'm going to powerful. You're very accurate. I'm going to break that into 2 parts. If you have a solo 401k and you're both making enough money to really double down on the 401k, and you have that solo, that's where Matt's talking about being up to a $60,000 range or whatever. It could only happen in a solo, and what you're now doing is grossing up your spouse's payroll so that he or she can really throw down in the 401k. Now, let me point out something here. This is after you did the Roth. See, if you're already funding the Roth IRA and you both put in $7,000, hey, $14,000 in savings, that's pretty good. But some people are like, hey, we had a great year in the business. We want to open a solo 401k and throw down another 23 each, and maybe even more with this backdoor strategy. That's the first thing Matt said. But when you have a group or a safe harbor 401k plan, because you have other employees, well, you say, well, I can't do the solo, so we're not going to do it. Whoa. You can still add your spouse to payroll and they could do $23,000. So now they're doing 7 in Roth and a 23 in a 401k that could be Roth as well. Now you're dumping $30,000 into your 401k and in your spouse's 401k. That could be the 60 you're referring to is combined.
Yeah.
But there's really the solo where it's even more with this backdoor strategy. And then you've got the 223s. I don't know. I may have made it more complex. I don't know.
Yeah. Well, I mean, if I really want to get a lot of retirement dollars in, because I do have the clients that are like, Matt, dude, I want as much Roth dollars as possible. Now in the Roth solo Ks, you can do $69,000 of entirely Roth money. Mm-hmm. And there's a reason to do that, because if I get a little nest egg of 69, 70K, let's say, that I can grow substantially tax-free, now I'm off to the races. And we've got the clients that have the 10, 100 million plus Roth accounts here. And so in those scenarios, I'm like, all right, let's pay you enough to max out even the 69K. I'm going to go past just the 23. I want to do 69K because this is last year, this is new, all of the contributions into a solo 401k can be Roth now.
Yeah, I'm going to just run the numbers here for fun on this. And let's say you do that for 10 years. You say, hey, the business is strong enough now. I'm going to gross up my spouse's payroll. Oh, my word. Are you kidding me? That couldn't be right. Oh my word. If my math is right here on my investment calculator, 69,000 I start, and then I'm going to continue 9 more years, and I'm going to get 8%, and I'm going to compound it annually and put in an additional, here we go. 69,000 every year. You'll have $1 million of Roth money in 10 years. So you start right now, you put in 69 grand, and you keep your spouse on payroll for just 9 more years, doing this $69,000 a year in Roth. At the end of those 10 years, you'll have $1 million tax-free. And for people, a married couple that are in their 40s or 50s, and they're like, we don't have much retirement set aside.
Yeah.
This is where you lock it down. And both of you could do this. Now you've got $2 million in Roth money.
Yes. And we have so many clients that are small business owners, self-employed, and they're like, no one set up a 401k for me. Matt, I'm 45. I don't have a 401k anywhere. I didn't work at a corporation that did a match and everything. It's all been on me. We're like, the solution is the solo K. It's freaking awesome. It's for you, small business owner with no employees.
I want to say another thing about this too.
And you can get a lot of money in.
Yeah.
It's not just $7K a year like an IRA.
Totally. And what's so important about this is, I'm guilty of this, is that the normal business owner, and if I ask any of you guys listening here that are a business owner on the podcast, let me ask you a question. What do you feel is your best, most safe investment? You, right?
Your business.
Your business. Yeah. You put it right back into your business. And I've done that for years. I was talking to a good farmer friend of mine up in Idaho. He's got thousands of acres of potatoes. And he was saying, Mark, look around. I've got these huge potato sheds where we put millions of potatoes every year. And you go and look at all my trucks and look at all my equipment. He goes, guess how much I have in my 401k? $50,000. After all this, he's my age, he's in his 50s, and he was like, I blew it. I put all my money back into the farm, all my money into trucks and barns and buildings and all this. And he goes, I'm scared to death. If there's a problem with my farm, I don't have any other bucket of money. And I could have been doing this every year for the last 10 years. And so the point being here is, you may go, well, 69,000 is a lot of money to put away every year for my spouse or even myself. Yeah, but didn't you put 69,000 back into your business? Couldn't you pulled 69,000 out of your business and maybe put it in a different bucket? That's what we're talking about.
Yeah. I know it's so hard because it's like, but man, I can, that 69K, I can make 200K more next year if I do that, And I think that's the thing where you got to be very intentional about reinvesting and growing your business is like, what is the return on investment in my business? Is this really going to pay off next year? And I know it's tough, and we're all stressed with this. I think one of the things to do is just be a little measured. If you're like, Matt, things are tight, and I've got to keep reinvesting just to stay competitive, then maybe you are like, I'm like, then just do the 7K in a Roth IRA every year. And maybe you got to do backdoor because you're high income. But the ones that do feel behind, and this is kind of the ones I do run into that are like in their later 40s, and we were talking about the people in their 40s and 50s that are the business owners that don't have this. They're making good money for the most part. Yeah. They might have upped their lifestyle a little bit too, and I can say you're a little guilty on that too. I know you've reinvested in your business, but you've upped your lifestyle too. Now's the time to start catching up with that. It is not too late. If you think about investing this account for another 20 years, I know you just did 10 years. If you're 50,
oh my gosh,
you're not even getting Medicare until you're 66, folks. Okay, so like you've got 16 years there. So a lot of times we're talking about even a 20-year horizon to keep investing and growing this money. So maybe it's only half of that. You're dropping 30K a year in. It's reasonable to do. Anyways,
now
we're getting on a tangent here.
No, we're not. I don't think this is the tangent, because when we say don't put your spouse on payroll for these other reasons, but do put them on payroll for this reason, this is a big reason.
This is numero one.
This is, and I'm going to just throw this out too. Here's what's going on in some of your heads listening. Yeah, Mark, that's nice. Matt, great idea. But I can take that $69,000 and go buy a rental property. Okay. And Mark, Matt, that rental property is going to make me a 20% ROI with mortgage pay down. You listened to our podcast last week, right? Mortgage pay down.
I wonder where you're going with this.
Appreciation.
I like this.
You know where I'm going?
I'm wondering.
You wonder?
I don't know.
You're in trouble. Mortgage pay down, appreciation, cash flow. I'm going to take that 69 and go buy a rental.
I know.
Oh, really? Oh, now you know. Yeah, go buy a rental in your Roth IRA. Take the 69 freaking grand. Put it into the Roth 401k and Roth IRA and go buy a rental in the retirement account. Remember that little tip that we talk about all the time here? See, you saw it coming now.
I know.
Hit you like a truck.
Yeah.
So the point is, so many Americans think, well, yeah, I could put that money back in my business, or I could go buy a rental property and get a 20% rate of return. But putting it in a 401k sucks because I just have Wall Street. No, you don't. Okay, you ready to have your brain blown? Same math right here in my calculator, 69,000. I did an 8% rate of return. So you say you can do 20% with a rental property. We're going to put 20% on this, and I'm going to do it in my retirement account. Oh, buckle up. What do you think it's going to be? Ready?
A lot more.
$2 million. I did a 20% return buying a rental property with my Roth. Did the same 9 years after the initial contribution of $69,000. Now I have $2,078,000 tax-free in my Roth IRA because I put my spouse on payroll and redeployed the money in the right way.
I mean, sign me up, you know. And here's the interesting thing on the numbers. Just I'm seeing the calculator too here is in the initial example at 8% rate of return, it was more of that million was actually what you put in. It was about 600K.
That's right. More total contribution
of what you put in is what's left there. You still got about 400K of investment growth. Okay. When we up the rate of return there, same time horizon. Now the vast majority of that money is the investment growth. Your money's working more for you, which makes sense as your rate of return gets higher. But this is one thing on the solo 401k or Roth IRAs in general is a lot of business owners and even our real estate investor clients, I'm grouping you in here too, that also haven't had retirement accounts because you thought I can just do real estate and get a better rate of return. Yes, do it in your retirement account too. So I'm not saying don't do real estate, just saying use the additional tool of the retirement account. And so, but this is a reason why we like adding a spouse to a W-2 is it gives more ability to make more contributions, get more money in, to start building this other nest egg. A lot of business owners, your business can have value. Hopefully you've grown it and scaled it. You got a team where you could actually sell this business. It's not just you and the business is going to die when you retire, but there can be some value in the business. But let's make sure we're peeling this other bucket aside. So you're not like stressed out like the farmer in Idaho that's like, if Five Guys isn't buying fries anymore, I'm a host.
No, seriously. It's crazy. Okay, now we're going to give you one last reason why we'll give you two of why you should and then have to. Another reason why you could or should put your spouse on payroll is for a healthcare strategy. It's called the health reimbursement arrangement. It works in a marriage situation where you can cover your spouse and all their medical of them and their dependents, which includes you. So in your typical S corporation, you're not going to be able to write off your medical expenses. You can write off the insurance, but all the copays, the deductibles, the dentist, the eyes, the chiropractic, whatever, you can't write that off in your S corp. But if you set up an HRA for your spouse through a support company, we can write it off. Now, it's a chapter in my book, The Tax and Legal Playbook. We've had podcasts on that. But putting the spouse on payroll, and it doesn't even actually require a W-2, but you're going to go through a pay function, and it's called the HRA. But then there's times you have to.
Yeah, and there is the scenario where you have to. Let's say you do have the business where you guys are both working every day in the office or at the storefront or on the job site, whatever it may be. Like this is their full-time job. Yeah. They need to be on payroll. You actually don't have a choice. Yeah. And so, but we do know so many families when there's a spouse involved is their role is more, they might have their own job or their own business even, or running the household, but they are still in this advisory function to you, the business owner, really working and running that business every day. And so we know we at least have that, and that's where we're saying don't chase putting them on payroll unless you're thinking about the solo K or the HRA strategy. We love it for those reasons because those are going to save you taxes and help you build wealth. But if they are actually working in the business, they need to be on payroll. You don't have a choice. I'm sorry.
Yeah. It's called materially participating. And it's a must. But then you can open up these other opportunities in the process. So, well, everybody, like I said at the beginning, this is a really actually interesting topic with a lot of twists and turns. Hopefully this has been helpful. Love being here with you. And please continue to share this podcast with your friends and family. Give us a 5-star. It allows other people to discover this little hidden gem out there on the airwaves. And appreciate all of you. And appreciate you, Matt. Great insights today. You look great today, by the way.
Thanks. I know we did a little red and blue today. I mean, a little...
Yeah, we're just patriotic.
Yeah, we got 4th of July coming up. We're just trying to get in the spirit here.
This is the patriotic show.
Damn straight.
It is, actually. This is going to be coming out on the 4th of July week, so we went red and blue. We planned it. See, we could have just played into that.
I know.
We gave away our opportunity to show some forethought and planning, but Oh, well.
Everybody that listens to this podcast know we do not plan.
Yeah, we got to do better than that.
Yeah, right.
We're shooting for that. All right. Well, thanks, everybody. See you next week, and enjoy the 4th of July holiday. Be safe, and make sure you do not hold the firecracker while you light the fuse. Be careful.
See you next time.